Have you ever felt that swirl of overwhelm when it comes to your money? Maybe you've heard people talk about getting rich slow and wondered if there's actually a straightforward path.
Yeah, something simple without chasing those hot tips or getting lost in all the jargon.
Exactly. If that sounds familiar, then you are definitely in the right place for this deep dive.
Indeed. The financial world, well, it often feels intentionally complicated, doesn't it?
Oh.
Almost designed to keep us guessing.
Right. So, our mission today is to cut right through all that noise. We're going to unpack the core wisdom from the Boglehead's Guide to Investing. The one by Taylor Larimore, Mel Lindauer, and Michael LeBoeuf.
It's a fantastic book. We really want to distill its philosophy, focus on those pillars.
Yeah.
Simplicity, keeping costs super low, and thinking long-term. Discipline.
Yeah, discipline is key. The goal is for you to walk away from this feeling not just informed, but genuinely empowered. We'll pull out some surprising facts, real-world examples, and actionable steps straight from the book.
It's all about finding a calm, practical way to take control of your financial future. Really empowering.
Okay, so where do we start? The book kicks off by looking at your sort of financial starting point. It draws this really vivid contrast between two lifestyles, the borrowers and the keepers.
And that's not just a label, is it? It's about mindset. The borrowers, well, they're often living on what feels like a house of cards.
Yeah, building up debt, financing almost everything, fancy cars, big houses, often with very little money down. Their whole philosophy seems to be, forget tomorrow, live for today.
Right. And they treat credit cards almost like extra income, just paying the minimum each month.
Which leads them, as the authors put it, into a state of negative wealth. It's that classic phrase, big hat, no cattle.
They look prosperous on the surface, but one bad break, a job loss, an illness, and the whole thing can just unravel. Repossessions, foreclosures. It's a fragile way to live.
It really is. But then you have the keepers. They approach things completely differently.
Totally different mindset. The first thing they do when they get paid, put aside at least 10% for saving and investing, right off the top.
They're smart about it too, right? Using employer matching in their retirement plans, maxing out things like Roth IRAs if they can, using credit cards just for convenience.
And paying the balance off every single month. If they have debt, it's usually strategic, like an affordable mortgage or maybe student loans that help boost their earning potential.
They get that life's meant to be enjoyed now, sure, but true freedom. That comes from that long-term financial discipline.
Which brings us to this really crucial shift in perspective the book talks about. Moving away from a paycheck mentality towards a net worth mentality.
That's such a good point. Society often mixes up high income with actual wealth, doesn't it?
Absolutely. We see someone with a big salary and just assume they're rich. But the book makes it clear. Income and wealth, well, they're related, but they're definitely not the same thing.
So your net worth, that's your total assets minus all your liabilities, your debts. That's the real measure. Calculating that maybe once a year isn't just some exercise.
No, it's your baseline. It's how you chart your actual progress towards financial freedom.
Okay, so once you've got that net worth mindset, what's the absolute first thing the book says to do?
Pay off high interest debt, especially credit cards. I mean, think about it. Those interest rates can be brutal, 12%, 20%, even up to 30% or more sometimes.
Wow, so paying that off.
It's literally the highest risk-free, tax-free return you can possibly get on your money. Guaranteed.
That totally reframes how you think about paying down debt, doesn't it? It's not just getting rid of a negative. It's like making a guaranteed investment in yourself.
Exactly. The authors are pretty blunt about it. Why do banks and credit card companies have those giant, shiny skyscrapers? Because they're making money off your potential net worth through those high interest charges.
Ouch. Okay, so debt's tackled. What's next?
The emergency fund. This isn't optional, it's fundamental. You need that cushion for peace of mind.
Keep it somewhere safe and easy to get to, right? Like a savings account or a money market fund.
Precisely. Safe and liquid. So when those unexpected things pop up, and they always do, you don't have to raid your long-term investments.
So get rid of high-interest debt, build that emergency cushion. If you can do those two things,
then you are absolutely ready to become a Boglehead investor.
All right, let's talk about the part that sounds almost magical. Starting early and saving regularly. We hear about compound interest, but the book really emphasizes something deeper, doesn't it? Like patience beating frantic action.
It really does. That penny example they use is so powerful, not just for the math, but because it challenges our need for instant results.
Remind us how that goes again.
You start with just one penny, and you double it every day for 30 days. That tiny amount. It explodes to over $5.3 million.
It's wild. No wonder Einstein supposedly called compounding the greatest mathematical discovery.
And the rule of 72 makes it easy to grasp. Just divide 72 by your expected annual rate of return.
And that tells you roughly how many years it takes for your money to double. Simple, but wow, it shows how small, consistent steps build massive wealth over time.
When you see the real-world numbers, it really hits home. Like investing just $601 a month in index funds, assuming maybe a 10% average annual return over 30 years, that could grow to nearly $1.25 million.
Or the example for a child, just 54 cents a day, again at 10% average, could potentially hit over $1 million by age 65. It's mind-blowing that such small amounts can do that. So why don't more people actually do it?
Well, that's what those economists, Venti and Wise, looked into. Their study on wealth at retirement was fascinating.
What did they find? Was it about picking great stocks or just luck?
Nope. Not really health, not amazing investment picks, not even luck. The single biggest factor, simply the choice to save more money. Consistently.
So it's not some secret formula, it's just deciding to save.
Pretty much. It's about making that conscious choice, paycheck after paycheck, to prioritize saving.
Which is why the Bogleheads hammer home that idea of paying yourself first. Set aside at least 10% from every paycheck, right?
Minimum 10%. And if that sounds like too much right away, they suggest starting small, maybe just 1%, then bump it up by 1% each month for a year.
Ah, that's clever. So you ease into it, build the habit, and after a year, you're saving 12% without that big initial shock.
Exactly. And finding that money often comes down to reducing spending, which can actually be more powerful than earning more, because extra earnings get taxed.
Like the car example.
Yeah, that's a great one. Instead of buying a new car every few years, what if you bought a reliable 3-year-old used one instead? That could easily save you, say, $2,500 a year.
And if a 19-year-old invests that $2,500 saving each year, assuming maybe an 8% return.
By age 65, that simple choice could compound to over $1.1 million. It's incredible.
And the book also mentions side hustles, right? Another way to find money to invest.
Absolutely. Any extra income stream helps accelerate things.
Okay, so foundation built. Now we get to the Boglehead core. Simplicity, low costs, index funds. And this is where investing gets, well, kind of weirdly counterintuitive.
It really is. Think about most things in life. If you don't know how to do something complex, what do?
You hire an expert, right? And you generally expect that you get what you pay for.
Exactly. And if there's a crisis, our instinct is take action. Do something now.
But the book argues those very same principles, they often lead you straight to failure when it comes to investing.
Because the short-term market is basically random noise. It's unpredictable. There's just no reliable way to consistently pick winning stocks or perfectly time the market ups and downs.
So understanding that what works everywhere else doesn't work in the market, that's step one.
That's a huge part of the Boglehead insight. It's contrarian, but it's key.
Okay, you're making a strong case against trying to be clever. But that idea of just being lazy with your money, it feels wrong somehow. How does the book convince us that just sitting back with index funds is actually better?
Yeah, the lazy approach. The book calls index investing a Walter Mitty strategy. Requires almost no special knowledge, no real skill, hardly any time.
And
yet, historically, it beats something like 80% of the professional active fund managers trying to outperform the market.
80%? Wow. So what is an index fund for anyone who's not sure?
It's beautifully simple.
Yeah.
An index fund just holds all the stocks or bonds in a specific market index, like the S&P 500 or maybe a total stock market index. It aims to just match the market's performance, not beat it.
And it's run passively, by computers mostly.
Exactly. No highly paid manager making guesses, no frequent trading trying to time things. That passive approach, free from human emotion, and crucially, the high costs of active management. That's the secret sauce.
Okay, let's talk costs, because the Bogleheads are really big on costs mattering.
Immensely. Take sales commissions first. They're often called loads. Some funds charge you just to buy them.
Like if you invest $10,000 in a fund with a 5% front load.
Poof. $500 is gone right off the bat. Only $9,500 actually gets invested for you. The authors have that great line.
More than likely, you are paying for the broker's Mercedes. Yeah, I remember that.
It's blunt, but it makes the point.
Yeah.
And then there are the ongoing costs, the expense ratios. These are even sneakier because they nibble away every single year.
Active funds might charge, what, 1%, 1.5%, even 2% a year?
Sometimes more. Whereas index funds, often well under 0.5%. Vanguard, Fidelity, some are down around 0.03% now. Tiny.
And that difference adds up, right? The book had an example.
A really powerful one. $10,000 invested, say it earns 10% a year on average for 20 years. With a 1.5% expense ratio, you end up with just under $50,000.
Okay.
But with a low 0.5% expense ratio, you end up with over $60,000. That seemingly tiny 1% difference in fees costs you over $11,000. It compounds to an 18% difference in your final amount.
18% less money just because of fees. That's staggering.
It's why Jack Bogle himself called high fund costs the deadliest sin of all. And Rick Ferry's quote is also spot on.
The one about Wall Street. Wall Street wants you to believe they're there to make money for you, but their true purpose is to make money from you. Really puts the industry's incentives in perspective.
It does. But the good news, the really good news, is that these low-cost, no-load index funds are everywhere now. Vanguard, Fidelity, T. Rowe Price, Schwab, they all offer them.
And you don't need a fortune to start, right? Some places let you start with maybe $50 a month.
Absolutely. Firms like TIACRF have had automatic investment plans with low minimums for ages. They're incredibly accessible.
Okay, so foundation, check. Index funds and low costs, check. Now, the long game, sticking with it. This starts with asset allocation, which the book calls the absolute cornerstone.
Forget trying to pick the next Apple or timing the market crashes. Decades of research, like that famous Brinson-Hood-Biebauer study.
What did that show again?
It showed that your asset allocation, basically your mix of stocks, bonds, and cash, determines something like over 90% of your long-term investment returns and your risk level.
Over 90%, just from the mix, not from picking the winners.
Exactly. It's the most important decision you'll make. And it's deeply personal. It has to align with your sleep factor.
Your sleep factor, meaning?
Meaning, how much of a drop in your portfolio's value can you stomach without totally freaking out and selling everything at the worst possible time? That's your risk tolerance.
Right. Stocks are great for long-term growth, but they bounce around more. Bonds are steadier.
Precisely. And the book gives some perspective. Like, over an 85-year period, if you held large U.S. stocks for any 10-year stretch, the worst loss you'd have seen was only about 1%. Compare that to the worst one-year loss of 43%. It shows what long-term really means.
So asset allocation first, then diversification. Warren Buffett's quote is great here.
Diversification is a protection against ignorance. Love that.
Yeah.
And true diversification isn't just owning like 15 or 30 different stocks.
No, it's owning the whole market, right? Which index funds make super easy, like a total stock market fund.
Exactly. You own a tiny piece of thousands of companies. And critically, don't just stick to the U.S.
International diversification.
Absolutely crucial. The U.S. stock market is only about half the world's total market value. Yeah. Owning international stocks gives you broader exposure and smoother returns sometimes, because different markets don't always move together.
What's the recommendation there? Bogle himself was a bit cautious, wasn't he?
He suggested maybe capping international at 20% of your stocks. The authors of this guide lean towards maybe 20% to 40% for potentially better diversification.
Okay, this leads us to maybe the biggest hurdle for investors: fighting the urge to chase past winners or time the market. That disclaimer, past performance is no guarantee.
It's not just legal padding. It's the absolute truth. Backed by tons of evidence, study after study, Carhart, Barra, Burke and Green, Vanguard, they all show the same thing. Last year's winners rarely repeat. Past performance just doesn't reliably predict future returns.
The book had some brutal examples, didn't it? Like the Forbes Honor Roll funds?
Oh yeah. Forts picked their best funds. Over 18 years, $10,000 invested in those supposedly great funds grew to about $75,000. That same $10,000 in a simple, boring Vanguard index fund grew to over $103,000. The experts got crushed by the index.
And market timing, trying to jump in and out.
Even worse, defined as predicting short-term moves. The book mentions studies, disastrous attempts by professionals losing huge amounts. It just doesn't work consistently.
And the financial media doesn't help, does it? All that noise.
Exactly. It's a stock picker's market. The trend is your friend. Catchy phrases designed to get you to do something, to trade, because that's how they make money. Commissions, fees, not necessarily how you make money.
So the Boglehead mantra comes down to:
stay the course. It sounds boring, maybe even passive. But as Frank Armstrong said, buy and hold is a very dull strategy. It has only one little advantage. It works.
Very profitably and very consistently. And Jack Bogle called it the single most important piece of investment wisdom. Even Buffett says inactivity is often intelligent behavior in investing.
It all ties back to controlling your emotions, doesn't it? Which brings us to behavioral economics.
Right, the psychology of money. It's weird we get emotional about earning money, but being emotional about investing it is usually a disaster.
It is. Pioneers like Tversky and Kahneman showed how we humans often make irrational economic choices. We rely on these mental shortcuts, these judgmental heuristics that are often driven by emotion, not logic.
What are some of the common traps the book highlights?
Oh, there are plenty. Overconfidence is a big one. Remember the Mensa Investment Club? Super high IQs.
Yeah, their returns were terrible compared to the market index, like 2.5% versus over 15%.
Exactly. And even Nobel laureates aren't immune. Look, long-term capital management. Brilliant minds blew up spectacularly. Then there's loss aversion.
The fear of losing money being stronger than the desire for gain.
Right. It makes people hoard cash in low-yield accounts where inflation just eats away at their purchasing power. They're losing money slowly, but it feels safer than risking a market drop.
And following the herd. Buying when everyone else is euphoric, selling when everyone panics.
The classic recipe for buying high and selling low. The Dalbar studies show this year after year investor returns lag fund returns because people chase performance and panic sell. Herd mentality often leads investors to the slaughterhouse, as the book puts it.
Even mental accounting. Treating, say, a tax refund like found money instead of your own money you overpaid.
Yeah, all these biases trip us up. The solution the book offers. It's simple, but hard. Be dispassionate about investing.
Get your excitement somewhere else.
Exactly. Let investing be boring, calm, consistent, profitable over the long run.
Okay, so we've built the wealth, stayed the course. What about protecting it and planning for the future? The Boglehead philosophy extends here too, right?
Absolutely. Long-term, low-cost thinking applies to financial planning essentials too. First up, taxes.
Tax efficiency. That silent drag on returns. The Schwab study was eye-opening.
Wasn't it? $1 invested over 30 years. In a tax-deferred account like a 401k, it grew to almost $22. In a regular taxable account,
only $9.87, less than half, just because of taxes.
It hammers home why you absolutely need to prioritize maxing out those tax-advantaged accounts. First, 401k, 403bs, IRAs, Roth IRAs. That Roth IRA benefit of tax-free withdrawals later is huge.
And for money you invest outside those accounts, in regular brokerage accounts.
Stick with tax-efficient investments. Low-cost index funds are great here too because they don't trade much, minimizing capital gains, and often generate more tax-friendly qualified dividends.
What about windfalls? Like an inheritance or lottery win. Seems like good news, but the stats are scary.
They really are. Over 75% of windfalls just get squandered. Lottery winners often broke again within 3 years.
So what's the advice?
First, just pause. Chill out, as the book says. Don't do anything rash. Then figure out the after-tax value. That $1 million windfall might only be $600,000 after taxes.
And that $600 K invested might only generate $24,000, $30,000 a year in income. It's not infinite money.
Exactly. Perspective is crucial. And then get objective advice. Fee-only professional CPAs, estate planning attorneys, not commissioned salespeople.
Avoid the fox guarding the hen house. Good advice. What about insurance?
Or principle. Insurance is for protection, not for investing. Don't mix them.
So only insure against the big things you couldn't possibly afford to cover yourself. Catastrophes.
Right. And take the highest deductible you can comfortably manage. That lowers your premiums. Key types are term life insurance. Just pure protection, no complex investment component. Major medical health insurance, maybe an HSA.
And disability insurance.
Crucial, often overlooked, but it ensures your single most valuable asset, your ability to earn an income in the future. More people become disabled during their working years than die prematurely.
Good point. Finally, estate planning, making sure things go where you want them to.
Yep. Wills, maybe trusts, depending on your situation. It's about ensuring your assets go to your chosen heirs efficiently, minimizing taxes, avoiding the delays and costs of probate. Things like the stepped-up cost basis for heirs can be a huge tax saver, too.
It's the final piece, ensuring your legacy is handled according to your wishes.
Exactly. Otherwise, the state decides for you based on generic laws, and the tax authorities might get a bigger slice than necessary.
So wrapping this all up, what's the big takeaway for you, the listener? The core message from the Bogleheads?
It's incredibly empowering, really, that quote. Though no one can go back and make a brand new start, anyone can start from now and make a brand new ending.
I love that. The Boglehead way, it's simple, it's proven effective, and it's truly accessible, no matter where you're starting from.
So let's quickly recap those keys. Choose a sound financial lifestyle. Be a keeper, not a borrower. Start early, invest regularly, let compounding work its magic through patience.
Keep it simple. Use low-cost, broadly diversified index funds. Understand how much costs matter. Understand taxes matter. Use those tax-advantaged accounts.
Diversify globally.
Yeah.
Protect yourself with appropriate insurance for catastrophes. And maybe the biggest one, master your emotions. Don't let fear or greed drive your decisions.
Yeah, that emotional mastery. It feels like the central challenge, doesn't it? It's not about finding the secret stock or predicting the market. It's about looking inward.
Having the discipline to just ignore the noise, ignore the crowd, and stick to your sensible, long-term plan. Even when it feels really uncomfortable, be dispassionate, let the market do the heavy lifting, focus on what you actually can control, your saving rate, your costs, your plan.
You absolutely can do this. It's a powerful, simple path.
And if you want to learn more or connect with others following this path, definitely check out www.bogleheads.org. It's a fantastic, free community, tons of knowledgeable people ready to share insights and answer questions.
Great resource. So the final word from the Bogleheads.
Make your plan and then stay the course.